Step number 3, determining the transaction price. Transaction price means amount of consideration which the customer will pay to the entity. That means amount of consideration which an entity expects to be entitled in exchange for transferring promised goods or services to a customer. Transaction price excludes amount collected on behalf of the third parties. That means transaction price excludes GST. So GST is not included in transaction price because GST is collected on behalf of the third party. Third party means here government. The consideration promised may be either fixed or variable or both. Transaction price includes variable consideration and fixed consideration as well. First one, let us consider about variable consideration. Variable consideration. The consideration would be variable if either a product was sold with a right to return or a fixed amount is promised as a performance bonus on achievement of a specified milestone. So a consideration will be variable if there is right of return or there is any performance bonus. Variable consideration may be fixed in amount, but the entity's right to receive that consideration is contingent on the future outcome. Penalty. Penalty is also a form of a variable consideration. It will be deducted from transaction price. It is something like a negative variable consideration. Penalty is something like negative variable consideration. How to estimate the amount of variable consideration? An entity shall estimate the amount of variable consideration by using any of the following methods. There are two methods. Another first one, expected value method. Second one, the most likely amount method. Expected value method is used when there is multiple outcomes are possible. Most likely amount method is used when there are only two possible outcomes. What is expected value? Expected value is the sum of probability weighted amounts in a range of possible consideration amounts. Summation of probability into weights will give expected value. Most likely amount is a single most likely amount in a range of possible consideration amounts. That is a single most likely outcome. What are the constraining estimates of variable consideration? Variable consideration shall be included in the transaction price only when it is highly probable that significant reversal will not occur. So variable consideration will be included in transaction price only if we are sure that no reversal is possible. In that condition only, variable consideration will be included in transaction price. What are the factors that increase the likelihood or magnitude of a revenue reversal, including any of the following? These are the factors which increase the likelihood, that means probability or magnitude of revenue reversal. Amount of consideration is highly susceptible to factors outside entity's influence. Uncertainty about the amount of consideration is not expected to be resolved for a long period of time. Entity's experience or other evidence with similar types of contracts is limited or has limited predictive values. An entity has a practice of either offering a broad range of price concessions or changing payment terms and conditions of similar contracts in similar circumstances. Or contract has a large number and broad range of possible consideration amounts. These are the factors that increase the likelihood, that means probability or the magnitude of revenue reversal. A reassessment of variable consideration. At the end of each reporting period, an entity shall update the estimated transaction price, including updating its assessment of whether an estimate of variable consideration is constrained. So, at the end of each reporting period, the variable consideration will be reassessed, including constraints of variable consideration. Next, significant financing component. An entity shall adjust the transaction price for the effect of the time value of money. If the timing of the payments agreed, either explicitly or implicitly, provides the customer or the entity with a significant benefit of financing. That means, if credit is provided, interest will be charged for such credit period. That will be the significant financing component. Here, either party may benefit from financing. That is, customer may pay before the entity performs its obligation. That is a customer loan to the entity, or customer may pay after the entity performs its obligation, a loan by the entity to the customer. Here there will be two types of situations. In the first case, customer will pay the first. Next, performance obligation will be performed by the entity. This will be considered as customer loan to the entity. Loan provided by customer to the entity. Second case, first performance obligation will be performed by the entity and then customer pays. In such a case, it is treated as loan provided by the entity to the customer. In both the cases, there will be financing components. In both the cases, significant financing components will be recognized. The financing component is recognized as interest expense. That is, when the customer pays in advance, or interest income when the customer pays in arrears. In the first situation, interest expense will be recognized. In the second situation, interest income will be recognized. The interest income or interest expense will be recognized over the financing period using the effective interest method described in the Ind AS 109. So interest will be recognized using effective interest method. Next, discount rate will be used here. Discount rate is the rate at which entity could have taken finance. If that rate is not available, then the entity can compute IRR. IRR means internal rate of return, that is effective interest rate, which equates the promised consideration and the cash selling price. A contract would not have significant financing component if any of the following factors exist. If any of the following factors exist, then there will be it is considered as there is no significant financing component. First one, customer paid for goods or services in advance and the timing of the transfer of those goods or services is at the discretion of the customer. In such a case, it is assumed that there is no significant financing component. Example, consider a prepaid card for mobile phone services, wherein the customer has the discretion to avail mobile services within a certain band of time. In such a case, it is considered as there is no significant financing component. Second, a substantial amount of consideration is variable based on future event that is not within the control of the customer or the entity. For example, if the consideration is a sale-based royalty, in such a case, it is assumed that there is no significant financing component. Next, difference between promised consideration and cash selling price arises for reasons other than the provision of finance. Example, payment terms might provide the entity or the customer with protection from other party failing to adequately complete its obligations under the contract. In such a case also, it is assumed that there is no significant financing component. So in all these cases, no interest income or interest payment will be recognized. Next, non-cash consideration. Sometimes a customer promises to pay for goods or services in a form other than cash, such as shares, advertising, or equipment. That means here consideration is not cash, consideration is other than cash, like shares, advertisement, or equipments. To determine the transaction price in such cases, first preference will be given to fair value of non-cash consideration received. Second preference will be given to standalone selling price of the goods or services given. So first preference will be given to fair value of non-cash consideration received. For receipt, first preference will be given. Second preference will be given for given cases. Customer provided goods or services. If a customer contributes goods or services, for example, materials, equipment, or labor, to facilitate an entity's fulfillment of the contract, the entity shall assess whether it obtains control of those contributed goods or services. That means here customer is providing the raw materials, that is goods or services, to facilitate completion of the contract. Customer is providing goods or services to the entity. If entity obtains control, then fair value of goods or services supplied by the customer will be added to the transaction price. If entity does not obtain control, then fair value of goods or services supplied by the customer will not be added to the transaction price. So if control is obtained, it will be added to transaction price. If control is not obtained, it will not be added to transaction price. Next, consideration payable to a customer. Consideration payable to a customer includes cash amounts, coupons, vouchers that an entity expects to pay or that may be applied against amounts owed to the entity. Consideration payable to the customer. If that consideration relates to distinct goods or services received from the customer and consideration does not exceed the fair value of distinct goods or services received, then such consideration will be accounted separately. That is, in the same way, the entity accounts for other purchase from suppliers. If consideration is related to distinct goods or services received from the customer and consideration exceeds the fair value of distinct goods or services received, then that excess consideration will be reduced from the transaction price. That is, we need to account for the excess as a reduction of the transaction price. And the remaining part is accounted from suppliers for a purchase from supplier. So remaining will be considered as a purchase from suppliers. If consideration payable to a customer does not relate to distinct goods or services, then account for that consideration as a reduction of transaction price. That means it will be reduced from the transaction price. Next. Consideration paid or payable to a customer can take many different forms. Some common examples of consideration paid to customer are given below. First one, slotting fees. Customer provided goods or services. If a customer contributes goods or services, for example, materials, equipment, or labor, to facilitate an entity's fulfillment of the contract, the entity shall assess whether it obtains control of those contributed goods or services. That means here customer is providing the raw materials, that is goods or services, to facilitate completion of the contract. Customer is providing goods or services to the entity. If entity obtains control, then fair value of goods or services supplied by the customer will be added to the transaction price. If entity does not obtain control, then fair value of goods or services supplied by the customer will not be added to the transaction price. So if control is obtained, it will be added to transaction price. If control is not obtained, it will not be added to transaction price. Next, consideration payable to a customer. Consideration payable to a customer includes cash amounts, coupons, vouchers that an entity expects to pay or that may be applied against amounts owed to the entity. Consideration payable to the customer. If that consideration relates to distinct goods or services received from the customer and consideration does not exceed the fair value of distinct goods or services received, then such consideration will be accounted separately. That is, in the same way the entity accounts for other purchase from suppliers. If consideration is related to distinct goods or services received from the customer and consideration exceeds the fair value of distinct goods or services received, then that excess consideration will be reduced from the transaction price. That is, we need to account for the excess as a reduction of the transaction price. And the remaining part is accounted from suppliers for a purchase from supplier. So remaining will be considered as a purchase from suppliers. If consideration payable to a customer does not relate to distinct goods or services, then account for that consideration as a reduction of transaction price. That means it will be reduced from the transaction price. Next. Consideration paid or payable to a customer can take many different forms. Some common examples of consideration paid to customer are given below. First one, slotting fees. Manufacturers of consumer products commonly pay retailers fees to have their goods displayed prominently on store shelves. Slotting fees. Manufacturers of consumer products commonly pay retailers fees to have their goods displayed prominently on store shelves. Those shelves can be physical, that is, in a building where the store is located, or virtual, that is, they represent space in an internet reseller's online catalog. Generally, such fees do not provide a distinct goods or services to the manufacturer and are treated as a reduction of the transaction price. So slotting fees paid to the customer will be reduced from the transaction price. Second, cooperative advertising arrangements. In some arrangements, a vendor agrees to reimburse a reseller for a portion of the cost incurred by the reseller to advertise the vendor's products. The determination of whether the payment from the vendor is in exchange for a distinct goods or services at fair value will depend upon a careful analysis of the facts and circumstances of the contract. For example, mobile company sells 1,000 phones to retailers for 10 lakhs. The contract includes an advertising arrangement that requires mobile company to pay 1 lakh towards a specific advertising promotion that retailer will provide. The payment from mobile company to retailer is consideration for a distinct service provided by the retailer and reflects fair value. The advertising is distinct because mobile company could have engaged a third party who is not its customer to perform similar services. The transaction price of 10 lakhs and is not affected by the payment made by the retailer for the sale of the phones. Here the amount paid to the customer will be reduced from the transaction price. Next one, price protection. A vendor may agree to reimburse a retailer up to a specified amount for shortfalls in the sale prices received by the retailer from the vendor's products over a specified period of time. Normally, such fees do not provide a distinct goods or services to the manufacturer and are treated as reduction of the transaction price. So the price protection charges paid to the customer will be reduced from the transaction price. Next, step number 4. Allocating the transaction price to performance obligations. Allocate the transaction price to each performance obligation or distinct goods or services on a relative standalone selling price basis, except for allocating discounts and for variable consideration. So transaction price should be allocated to performance obligations on the basis of standalone selling price. There are two exceptions to the above principle of allocation the transaction price based on standalone selling price. The exceptions are, first one, allocating discounts and allocating variable consideration. Next, determining standalone selling price. What is standalone selling price? Standalone selling price is the price at which an entity would sell a promised goods or services separately to a similar customer under similar circumstances. That means unbiased selling price. If a standalone selling price is not directly observable, an entity shall estimate the standalone selling price by applying estimation methods. A combination of below methods may also be used. There are three methods. First one, adjusted market assessment approach. Second one, expected cost plus margin approach. Third one, residual approach. First one, adjusted market assessment approach. The price of the competitors, similar goods or services, and adjusting those prices to reflect the entity's cost and margins should be considered in case of adjusted market assessment approach. Second one, expected cost plus margin approach. Forecast its expected cost for each performance obligation and then add an appropriate margin for that goods or services in case of expected cost plus margin approach. Third one, residual approach. Here, total transaction price less sum of observable standalone selling prices of other goods or services in the contract after allocating discount will be considered in case of residual approach. An entity may use a residual approach to estimate the standalone selling price only if entity sells the same goods or services to different customers for a broad range of amounts, or such goods or services has not previously been sold on standalone basis and its prices are not yet decided. That means residual approach is used in case customers are different or there is no previous history of sale of such goods or services. In any of the cases, residual approach is used. An entity shall allocate the discount before using the residual approach to estimate the standalone selling price of goods or services where the discount is allocated entirely to one or more performance obligations in the contract. That means before using the residual approach, discount needs to be allocated. So first, discount allocation will be done. Second, use the residual approach if conditions are satisfied. Next, allocation of discount. How discount is allocated? The entity shall allocate discount proportionately to all performance obligations on the basis of standalone selling prices of distinct goods or services, except when entity has evidence that entire discount relates to one or more, but not all performance obligations. That means generally discount will be allocated on the basis of a standalone selling price only, except discount is pertaining to one or two elements. In such a case, discount will be allocated to one or two items only. It will not be allocated to all items on the basis of standalone selling prices. When to allocate discount to less than all performance obligations? When the entity also regularly sells a smaller bundle of some of those distinct goods or services at a discount, and discount attributable to the smaller bundle of goods or services is substantially the same as the discount in the contract. In such a case, discount will not be allocated to all performance obligations it will be allocated to less than all performance obligations. For example, that means 1 or 2 items only. Next, allocation of variable consideration. Variable consideration may be attributable to entire contract or a specific part of the contract. Changes in transaction price. After contract inception, that means commencement of the contract, the transaction price can change for various reasons. If the change in transaction price is the result of a contract modification, then the entity should follow the contract modification guidance. That means if transaction price changes because of modification of the contract, then follow contract modification accounting guidance.